Well, not what we wanted, but the inflation trend is looking like a trend. Inflation in the US just came out higher than expected and barely than expected. We'll talk about that in a bit, but nonetheless, not good. So what does this mean for the stock market? What does it mean for the housing market? We'll be discussing all of that. Let's get into it. All right, so the Fed target for CPI has always been 2%. They're not wavering on that. A lot of economists say they should be changing that to maybe 2.5, maybe 3%. Now that we're in modern times, the economy is different, the world is different, it's a globalization environment. No, the Fed is holding to 2%. So let's go over some things quick. In January, CPI was 3.1. In February, it was 3.2. And in March, which just came out yesterday, in April, is 3.5. This is showing a trend of going up. Now, the whole talk has been it is normal for January and February to have higher inflation months because it's just after Christmas. There's a lot of Boxing Day sales that are extended into January, sometimes even into February. Lots of sales going on at all the stores, all the retail stores, trying to clear out all their inventory for the New Year's thing. So it's pretty normal to have inflation go up in January and February. But for it to go up in March, that's a little weird, a little strange, and that is not normal. And we'll talk about exactly why that was in a bit, but here's the thing. Everybody is waiting for interest rates to start going down, specifically in the US. Like the entire world is literally waiting. Canada, where I'm from, the UK, Australia, Germany, France, everybody is just waiting until the Fed cuts so everybody else can cut. See, the USD is the world currency. And if other countries start cutting before the Fed, making the US dollar worth even more in comparison to their currency, it's going to drop the currency in that country, maybe a little bit, maybe a lot. We'll see how that's going to go. But that's why all these other countries that are screaming recession is like right here, like literally Australia, the UK, and especially Canada. Recession is on their backs. They want to cut. They would have cut 4 or 5 months ago if they really had it their way, but they don't want to devalue their dollar so much. Now, it's going to come to a point where they're going to have to cut no matter what. Where in Canada, where I'm from, the bank governor, Tiff Macklem, just signaled yesterday, actually, at the time of filming this video, that they're going to cut in June. He said it in his roundabout way, but they're going to be cutting in June, and the U.S. is not going to be cutting in June. They'll be lucky if they start cutting in September, the way the data is looking anyway. We'll talk about that in a sec, but they'll be lucky to cut in September. So Canada is diverging. They're going to have to cut because the economy is getting so bad. Unemployment is getting so high. It's kind of a catch-22. What's worse, driving your economy off a cliff entirely because you're waiting and waiting for the U.S. to cut, or cut first and your dollar go down a couple of cents? There is repercussions to that. That does kind of suck for the economy, but you're going to be saving the broad economy from going bankrupt, essentially. So it's a pretty clear choice what's going to happen. And the Bank Governor of Canada kind of made that clear yesterday that that's what they're going to have to do if they got to do it. But not only that, consumers around the world and even in the US are waiting for the Fed to start cutting before they buy a house, before they go get a car, before they start spending a ton of money in the economy again. Everybody's holding on to their rations, waiting for this long predicted recession. This recession that's happening or going to happen, we'll find out when the data comes out eventually, is the longest predicted foreshadow of a recession ever in history. This has been the longest awaited recession that hasn't happened or is happening. Everybody's waiting for it. So there's a lot of talks of why this recession is probably going to be more of a shallow recession because everybody's been preparing for it for literally like 2 years. But nonetheless, everybody's waiting for those rates to come down so that they can buy the big ticket item they've been waiting for, primarily a house. Now, here's the thing that most people don't understand. If you look at the data and look at past recessions, everybody's waiting for the Fed to cut so they can go buy the stuff they want. But here's the thing. Historically speaking, when the Feds raise rates this high, the recessions happen as soon as they cut. And people don't realize they're in the recession oftentimes until 6 months, a year later, when they can look at the GDP data and all of the data, the consumer spending, and go, oh, wow, that was a recession. You made it through it, but that was the recession. And it's usually always when the Fed starts cutting. Because here's the thing, the Feds are looking at lagged data. They're always late to raise interest rates, and they're always late to cut interest rates. I mean, look at the whole pandemic. Inflation was through the roof, and then the Fed said, oh, damn, now we got to raise rates to start cooling down this economy. Well, dude, you were like a year too late. because you're looking at lag data. All of the data on shelter, on insurance, on goods and services, a lot of it is lagged, which is exactly what's going on right now. Leading to my next most important point of this video is that housing and shelter make up 60% of the CPI in the US. Let me repeat that. 60% of CPI is homes and rent. And here's the thing about rent. It's that the way they put this data together is they look at owners' equivalent rent, and how they do that is surveying by calling homeowners and saying, hey, if your house was for rent, what do you think your house would rent for? I don't know. I think I could probably get $2,000. I've seen a couple of rentals on the market here. My buddy has one down the street. He's renting his for $2,000. Yeah, I think my house would rent for $2,000. Thanks for the info, John. Like, what? That's how they calculate owner's equivalent rent for the most part. That is insane. That's the most rigged, shitty, uneducated data I've ever. That's what the government is relying on and throwing in the CPI, not looking at Zillow rents, not looking at Redfin, not looking at brokerages like Remax and all these other companies looking at their, no, not data. They're looking at owner's equivalent rent. Calling Joe Blow from fucking West Virginia and saying, hey, if your house was for rent, what do you think it would rent for? And again, this is all lag data because as we know with policy and monetary policy, it takes about 12 to 24 months from interest rates to cycle through the economy, specifically with insurance. Again, car and home insurance were up a lot in the month of March, putting upward pressure on CPI inflation. Again, everybody knows in the financial industry that insurance is lag data. The feds raise rates, and after a while, it trickles through the economy. And then the insurance companies obviously raise their insurance rates to make it profitable. And then that trickles through the economy for a couple of months. Like, dude, everybody's making moves on moves. It's reactionary. It's not real-time live data. All that to say that eventually, homeowners equivalent rent and rent is going... Dude, everybody knows if you're in the real estate industry in America right now, rents are tumbling in a lot of major cities, specifically like Austin, Texas. Rents are falling off a cliff. Rents are going down. Oversupply of rentals in a lot of these cities. Like, that's in the live data. But the homeowner Joes don't really see that just yet, so they're just saying what their house is going to rent for, and they're just throwing it in the CPI. It takes time for that to go through. All that to say, when we start getting more current data of rents actually going down, which we know they are. If you look at any real estate brokerage, all the rents are going down. That eventually is going to hit the CPI. And when it does, if real estate is 60% of the CPI, and eventually the real live data will hit, July, August, September, October. Eventually, this rental decline is eventually going to hit the CPI. And when it does, being that it's so heavily weighted, it's going to tumble like a rock. And so many economists have already predicted this. Like, it's not, you don't have to predict anything. It's just legit. That's what's going to happen. So like, everybody knows that inflation in the second half of the year should really start tumbling no matter what oil is doing. I know oil is up a lot. Gasoline is up again, big contributors to supply chains and all that. But who cares? Real estate is 60%. Like, are you kidding me? Eventually that data is going to hit, and when it hits, it's going to hit hard. It's going to have a huge impact in the numbers. So all that to say, we know where inflation is headed, most likely for the second half of this year, especially into 2025. Real estate's going to start going down. Prices, as we know, again, prices are down everywhere. In Florida, where I am right now, and primarily investing in, houses are down a lot. Houses are down in Texas. Houses are down in Tennessee. Houses are down in Chicago and New York. Housing is down in the live data. But that data doesn't hit the CPI for a couple of months. It's lagged. But once that shit starts hitting, oh my gosh, it's going to start tumbling. That's theory. That's logic. We'll see what happens. That's the end of this video. If you like this update and how we're all pretty much screwed, hit the subscribe button. I'll give you more economic updates and real estate investing strategies on how to stay ahead of the Fed. Because we don't care what the Fed does. We can still invest in real estate. We can still get great deals. We can still do our strategies of buy low, sell low. If you don't know what I mean, you got a sub for the next video. Talk to you soon.